Hey, this is a presentation on QM, our favorite latest alphabet soup name. What's qualified mortgage? And it's for internal training use only. Rules and terms to know. By the end of this, you're going to know all of these if you don't already, and most of you probably do. QM, of course, is qualified mortgage, and that's why we're here. ATR means ability to repay, and you'll hear more about that in a few moments. HPML is higher priced mortgage loan as opposed to the one right below it, high cost, which is the Section 32 one that we don't do. HPML loans we do, but they have some additional requirements, and you'll hear about that. Should have been, let me just get rid of that there. Should have been aware of HPMLs. We've been doing them for a while, and as of the changes last summer to the upfront mortgage insurance and the life of loan insurance for FHA, most of those loans fell into what became known as a higher priced mortgage loan category. And so HUD has actually changed their definition. It doesn't change the federal definition, but it changes the definition for FHA loans, and we'll talk about that in a moment. The last two terms at the bottom are really critical for you to know. Safe harbor and rebuttable presumption are the two statuses that you can get with QM loans, and it determines how much risk is attached to them. This nice little symbol over here on your left, the CFPB, that's their symbol, and always please remember that the first word in their name is consumer, and that's what they're all about. So if you're not sure about something, if you think of it in terms of does it hurt or help the consumer, generally, if it helps the consumer or it doesn't hurt them, it's probably going to be acceptable in a general way. If it hurts the consumer, I would practically guarantee that it won't work, and that the CFPB will tell us, hey, we can't do that. So if you have any questions about how things work, that's a good first blush to think about it when you're thinking about whether something would be acceptable or not, is whether or not it would be favorable for the consumer. Very brief history of QM and the ability to repay rules. I'm not going to go into this very long because, frankly, all of us would have had to have our head in the sand for the last year or more to not be aware that this was coming. The Bureau actually issued the ability to repay final rule in January of 2013, over a year ago. It's been updated several times throughout the year. And consequently, I think everybody was kind of holding their breath going, are you going to postpone it? Well, they didn't. So we're here. We're in a QM world, and we may as well learn to live with it and love it. This ability to pay and the QM rules were passed to implement the required provisions under the Dodd-Frank Wall Street Reform and Consumer Protection Act. You all remember that one. And the intent, of course, again, is to protect consumers from potential abuses in future financial dealings. And it all grew out of the fact that many consumers basically were given what could be considered an abuse or an abusive mortgage as a result of some of the kind of loosey-goosey rules we had going on in 2004 through 2008. The effective date for QM is applications taken dated on or after January 10th of this year. That's last Friday, for those of you that are listening live. And please note the little caveat below that, because HUD passed their own QM regulation in the middle of December. They waited a little long. Pretty much they went along with CFPB. They made a few different changes, but one of the things that's often missed is that their effective date is for case numbers assigned on or after January 10th. So you could have a situation where you took an application prior to January 10th, but your case number was ordered on or after January 10th, and it qualifies under QM if that's the case. So be very careful of those. That's something that would be pretty easy to miss. Fortunately, it's probably a short-lived problem as we work our way through it. I will tell you also that our investors pretty much, and ResMac's opinion, is that any application taken on or after January 10th pretty much needs to fall into QM as long as it's covered. Even the HUD ones, we'll take a look at those. But if you've got an earlier one that wouldn't normally be covered and the case number was ordered on or after, that's covered too. So let's talk about what loans are covered. Pretty much everything we do, and the only thing that's excluded is investment properties. That's the short version of this. The final rule applies to 1 to 4 family, closed-end credit transactions, both first lien and subordinate liens. So if we were to start doing second liens, they would be covered as well. They have a little bit different rules. And it's secured by a dwelling, including condominiums and co-ops. And the regulation applies to all primary residences as well as second or vacation homes. It doesn't apply to loans that are strictly for business use. So if you have a verified investment property where the borrower is not going to use it for more than 14 days each year, and that's the IRS definition, then it would not apply to that. Obviously, if you have a mixed-use property, and what I'm talking about there would be, say you've got a duplex, and you're going to live in one side and rent the other side, that would qualify as your primary residence. That would not be excluded, even though there's rental attached to it. And the other caution is, please be very careful, because we're going to be careful in looking at it in operations. Please be careful that if you are trying to say that a loan is truly an investment property and it appears that it could be a second home, it would be treated as though it would fall under QM. Let's talk about the types of qualified mortgages. There's basically two that you'll need to be worried about. See that little star up at the end? If you look down at the bottom, there's actually 4 categories. 2 of the categories are generally combined into one. They allow some expanded requirements, and they allow balloon loans, but only for small creditors. ResMac, thankfully, is too big for that. We make too many loans. We don't qualify as a small creditor, and so neither of those categories are available to us. So what we have available are the traditional or the standard qualified mortgage, which is also sometimes called regular. You'll see it called that too. Don't get confused. Anything that sounds regular, standard, traditional, that's good. That's a regular QM mortgage. The characteristics of a QM mortgage are that it has no negative amortization, can't have an interest-only period, it has no balloon payments except for the portfolio loans that are down there by these small creditors, but we can't do them. So no neg-am, no interest-only, no balloon. If you've been in this business for a while, things are sounding familiar. These are a lot of the products that were considered abusive, and that's why they're not allowed. Other characteristics of a QM mortgage are that the loan term cannot exceed 30 years, that the monthly debt-to-income ratio cannot exceed 43%, and there's a 3% points and fees cap. We're going to talk about all of those later in this presentation. The other type of qualified mortgage that we accept is a temporary, or what's known as an agency QM. It's called an agency QM for a really good reason. It has to be eligible for sale to Fannie, Freddie, USDA, FHA, or VA. Basically, it meets all of these standard QM under the regular, except for the DTI limit. As long as your agency allows you to exceed 43%, and they say it's okay, then that's acceptable. So if it's over 43, and otherwise meets requirements, that would be considered a temporary or an agency QM. So you got 2 types of QM, but you also have 2 possible statuses of QM, and that's safe harbor or rebuttable presumption. Safe harbor is kind of considered the good one, although rebuttable presumption isn't all that awful. So let's talk about them a little bit. Safe harbor basically is the non-HPML version. So the loan satisfies all QM criteria, and the APR is less than the APOR plus 1.5% for a first lien, or for a second lien, it's the APOR plus 3.5%. Or it can be safe harbor if it qualifies under agency-specific rules. That currently would be just FHA. They are the only one who has passed their own specific rule. They use a slightly different formula. And obviously they only do first liens on this. So for a first lien, instead of APOR plus 1.5, they do APOR plus 1.15% plus the annual MI, the yearly amount that's paid. Right now that's 1.35 for most loans. So you add those 3 up, and it's a higher limit than this. So a loan that might normally fall into HPML will not if it's under the safe harbor provision. And if you look down here in the red writing, HPML is the higher priced mortgage loan. That's also known, by the way, as a Section 35 loan. Those are acceptable. They do require additional review. They may require, for example, some residual income or whatever. They may not, by the way, pass into what would be classified as a Section 32 or a high-cost loan. We don't do those. A lot of places will not buy them. They're very high risk. They require special disclosures, and ResMac does not do Section 32 high-cost loans. Rebuttable presumption is the other status of QM. Again, it has to satisfy all of the QM criteria, but it's considered an HPML. In other words, it has higher fees or higher rates. So the APR equals or it exceeds this APOR plus 1.5 for first liens or 3.5 for second liens. And note that FHA specific is excluded from that. Even though it exceeds that, they use a different calculation. And the rebuttable part of rebuttable presumption is that the borrowers under this one, under the safe harbor, basically you're given a presumption of compliance. I have to use some legal words in here, right? With the ability to copay or the ability to repay requirement. That presumption of compliance, assuming you have the documentation and your data entry is accurate. So, you know, garbage in, garbage out. If you put things in wrong, it was in the past. But by the time everybody has looked at it, hopefully it's right. So as long as you've entered everything correctly and you have the documentation to back it up, if it meets this criteria, it protects the lender and the originator from borrower legal action based on ability to repay the debt. In other words, if it's a safe harbor loan, the borrower cannot sue the lender or the originator saying that, hey, you didn't prove that I could afford this loan. You didn't prove my ability to repay this debt, and you gave me a loan, and now I'm stuck and having problems. Rebuttable presumption is very similar to that, but it does allow a borrower could, for example, sue a lender claiming that they didn't document sufficient residual income or that they didn't keep enough documentation, and because it was higher than this APR that puts it into the HPML status, it puts the lender under the gun to be able to prove that they did this, that they basically did. So as long as we have sufficient documentation and we've validated residual income where it's required, we should be fine, even though it's rebuttable presumption. It's a little more risk. The one thing I want to point out to everybody, make sure you pay attention to this part. This is important. See down here where it says protects lender and originator? That's a little bit of a change. And if you're not used to it as a loan originator, as of January 1st, you as well as the lender are responsible for making sure that whatever is taken on the loan and given on the loan is accurate, and action can be brought against an originator as well. I guess it always could, but in this case it's been formally indicated as that. So be very aware of that. So as a result of the two types and two statuses, you can wind up having one of four combinations of QM loans. When we get to the end of this, I'll show you some samples of how the report looks, and it literally looks kind of like this. It says standard QM / safe harbor. Those are the ones we kind of hope for, but the others are all right too. Standard QM safe harbor status means that the DTI is not over 43, or it's in that agency category for FHAs. And it's not considered an HPML loan. It doesn't go into the higher priced mortgage loan category. In a case like that, that's probably the most safe of these four. The next one, standard QM, still the DTI is not over 43, but it exceeds the HPML measurements, so it becomes what is known as rebuttable presumption. That's a little riskier, but it's still acceptable. You can have exactly the same findings with your temporary or your agency QM. They can be either safe harbor or rebuttable presumption. They're basically for the same reason. If they're safe harbor, your DTI, in the case of an agency one, your DTI is over 43, but it's within your agency allowable guidelines, and the loan is not considered a higher priced mortgage loan. It doesn't go over that APOR plus limit, whatever it is. And on your temporary agency QM with rebuttable presumption, your DTI is over 43, but it's acceptable, or you get an approve eligible, whatever. However, it does exceed that APOR measurement. Even with FHA, it becomes a higher priced mortgage loan, and then it could require additional evaluation or overlay, such as residual income. Please notice this statement at the bottom, because this is a different concept We've always had some residual income, but we've never really codified it into standards, and we've just confirmed that, and it will be coming out, I think tomorrow morning. You'll see an actual publication on it. I didn't put it in this presentation because at the time that I wrote this presentation, we had not confirmed it yet, partly because a lot of different investors kept changing their mind. First few days of QM, things shake out, and they go, oh, I didn't need to do that. So residual income standards do have to be considered and applied to any loan over 43% or as determined by a specific agency's requirements. That's actually in the regulation. It is from the CFPB. So it's not that we're being nasty trying to implement residual income. We have to take a look at it. Ability to repay is one of the really important concepts to understand, and basically you're looking at this. You're looking at how much is your housing out of your income. Ability to repay requires the creditor to make a reasonable good faith determination that the consumer can actually repay the loan you're giving to them. That's kind of what it all comes down to. You don't want to make somebody a loan they cannot afford. Applies to closed-end transactions secured by a dwelling. We talked about that. And it restricts certain loan features, such as neg am, interest only. There's set caps and points and fees, which we'll talk about momentarily, and it imposes certain underwriting requirements, obligations to look at things like residual income. So it's no longer just up to underwriter discretion, it's actually a requirement. This first bullet is just a repeat that it must make a reasonable and good faith determination that the consumer will have a reasonable ability to repay the loan according to its terms. So if you're doing a 30-year loan, does that mean I have to figure out that this borrower is going to be still working at this level 30 years from now? No, not really, because my crystal ball isn't that good. But what you would want to look at is, do they show a pattern of work, a pattern of repay? Do they appear to have stable income where we could make the logical jump that, yeah, 5, 10, 15 years from now, they'll still be able to repay this loan? That's all that means, is reasonable and good faith. The other thing that's really important for those of you that do ARMs particularly, take a look at that bottom button, or bottom, whatever. Anyway, bottom dot. Use the maximum rate in the first 5 years after the first payment on a fully amortized loan. This was kind of a unintended consequence here. 5-1 ARMs, originally everybody was thinking, oh, yep, you don't have to worry about them. They're qualified at the note rate. Well, or the start rate. No, not actually. They're not, because if you think about a 5-year ARM, when is the first change date? Your first 5 years after the first payment, that'll cover the first change date. So you have to underwrite 5-1 ARMs at whatever the maximum first change date would be. That's something handy to remember. Obviously a 3-1, if there was one, you'd have to underwrite at whatever the maximum change would be at 5 years after the first payment. 7-1 ARM, 10-1 ARM, you're underwriting at start. Underwriting considerations that are required for all loans are to consider and verify income and assets, current debt obligations, alimony, child support. You come up with your monthly DTI, you look at residual income if necessary, and you underwrite to the monthly payment that would be using the maximum rate in effect 5 years after the first payment on a fully amortized loan. This isn't really too different from what we've been doing. Here's the specific basic 8 considerations that are laid out in the QM rules by the CFPB. And if you take a look at the bottom, this is also from that. In addition, residual income and/or assets or other underwriting conditions may be required depending on the individual loan. So let's look at these 8 characteristics, and I bet when we're finished, you're going to say, we're already doing that, because, yeah, we really are. This is just absolutely codifying it and laying it out, but you must do it. You have to look at the current and reasonably expected income or assets of the borrowers, the current employment status, provided you rely on that. Obviously, if somebody is retired, they're living on fixed income. They're not currently employed, but you are looking at their income. You're looking at the monthly payment on the loan. You're looking at the monthly payment on any other loans on this property. So if you're doing a simultaneous second or subordinating a second, that would be included, obviously. The monthly payments for property taxes, insurance, and any other costs related to the property, such as HOA association fees, additional insurance, ground rent, that sort of stuff. All of your debts, alimony, child support, and you come up with your monthly DTI and residual income. You calculate that. And the last thing is credit history. Well, frankly, anything new here? We're doing this anyway. The only thing that it's doing, as I said, is simply codifying it and saying you must do this. If it's over 43, you must look at residual income and so on. The only exception to that, by the way, is FHA. FHA has actually said, if it's acceptable, if it meets FHA guidelines, HUD guidelines, you're okay, even if it's over 43. The next section we want to talk about is points and fees. Because points and fees is, this is known as the 3% rule. If you've heard about that kicking around, everybody just refers to it. There's actually a couple variations on it for smaller dollar amount loans. You'll hear me refer to it, frankly, as the 3% rule. And if you really want to know where it is, it's in this 1026.32b1. It's the legal definition. If you plunk that into Google, it'll come up. For loans of $100,000 or more, it is 3% of the total loan amount. Note the star. We'll talk about that in a moment. There's higher caps for smaller dollar loans, $60,000 to just under $100,000, $99,999. Flat fee of $3,000. That's the most the caps can be altogether. And then if you're doing really small loans, $20,000 up to just under $60,000, it's 5% of the total loan amount. There's actually two categories below this, but I've never seen us do a loan below $20,000, so I didn't even put it in here. The figures will be indexed for inflation. That just means they're going to update it annually. It doesn't bother you right now. So see the little stars on the 3% and the 5%? That goes down here. It says to determine the amount. If it's a percentage-based cap, you determine the total loan amount, multiply it by 3% or 5%, and that's the maximum amount that can be charged fees and points to remain a QM loan. The total loan amount is simply the amount financed minus any points or fees that are already rolled into the loan amount. FHA uses a slightly different calculation because of their upfront MIP. And the good news is it's being done in Calyx and it's accurate. It's also done in DocMagic, and that one matches too. So let's talk about what fees are included. The short and dirty version, if you want to do a really quick estimate, is that most APR fees are included. There's a few that are excluded, and there's a few things that are included that aren't APR fees normally. So you do need to pay attention to it, but it would give you a general feeling for it if you just looked at APR fees. So here's the things that are included. Any real estate related fees, if they're paid to an affiliate of a lender or a broker, if this was a broker loan, or if a portion is retained by the lender, or if the charge is deemed not reasonable. Well, you guys probably don't charge unreasonable charges, because if you did, you wouldn't get any business. So you can kind of use that as a judgment of if it's reasonable. If it's being charged by other people in the area and it's reasonable and common, you're probably good. The next two categories really don't apply to ResMac because we don't do them. Premiums for credit insurance, life, and other insurance, we don't include that. We don't sell those as part of the loan transaction, so it doesn't apply. And maximum prepayment penalty, currently we don't offer any prepayment penalties on loans, so it doesn't apply. Broker compensation paid either by the lender or the borrower, that would only apply to a broker loan, so unless you're brokering a loan out, you don't have to worry about this one. Prepayment penalty paid if it's charged on the payoff of a refinance. Okay, this one's a little odd, guys, and it's something that you could miss really quickly. So make sure if you're doing a refinance that the processor, whoever that might be, whether it's you or someone else, takes a look at that payoff and makes sure there isn't a prepayment penalty on it, because if there is, it gets included in the 3 points, and there's no way to get around that. It could really mess you up if it wasn't included. So you may want to ask if there's any possibility that there would be a prepayment charge on a loan when it's being refinanced. Most of those, fortunately, I think have worked their way through the system, the old ones that had 3- and 5-year prepayment charges, but there could be still a few hanging around. The other thing that I do see prepayment penalties on once in a while is HELOCs that have not been open for more than 2 years. You will find lenders trying to recover their costs on those sometimes. And since if you were paying off the first and the second and you're wrapping that into this loan, that would count. So make sure you pay attention to those. And then finally, included fees continued. This is the other thing, finance charges, APR fees. All APR fees are included in your points and fees calculations unless they're specifically excluded, and here's the list of when you can exclude them. Interest can be excluded, so that's a little different. Monthly or annual mortgage insurance premiums that are paid after closing, including your FHA, your VA, USDA, your monthly payments and stuff, those are excluded, including PMI that's paid monthly. Conventional upfront mortgage insurance premiums up to the amount of the typical UF or the current UFMIP for FHA loans. Currently that's 1.75. So if you had a conventional upfront mortgage insurance premium and it was 2.75, you could exclude 1.75 of that, but you'd have to include 1% of it as points and fees. And that's as long as the policy itself meets the requirements to be prorated and automatically refundable. If it's a non-refundable, it's included. We'll talk a little bit more. I've got one or two other slides on mortgage insurance, so I'll talk just a little bit more about those in a minute. Third-party charges that are not retained by the lender, the broker, or an affiliate of either do not have to be included in this, even though they would normally be a finance charge if there's anything that falls into that. And finally, up to 2 bona fide discount points may be excluded from the test depending on the undiscounted rate. And basically they have to be legitimate buy downs, and it has to do with how far above the APOR you are. There's a specific formula for it. It is built into Calyx. It will do the test for you. It's also built into DocMagic. We do test using that. I can always add that if anybody wants the specific presentation. I just didn't throw it in here to save time. Here's one of the 2 slides on mortgage insurance. So let's talk about that just very quickly. The portion of the upfront premium is included if it's over 1.75. Anything under 1.75 is excluded, again, provided the policy meets the refundability. So very carefully consider the impact of the type of mortgage insurance you select for your borrowers if they have to have mortgage insurance. Sometimes it's dictated to you by AUS. Sometimes you can choose which kind you get the coverage on. I would highly recommend you access information about the various types on each MI company website. Radian and Magic, I know, both have QM buttons out there, and it takes you right to their information. It's actually very good. I've checked it, and it appears to be accurate. This one, in fact, is off of Radiance. As MI companies are still determining compliance, some policy types right now probably won't be available. I know Radian pulled a couple of them. They thought they had them all set, and I was on a webinar with them a little over a week ago, and all of a sudden they said, we're pulling these products because we suddenly realized that they don't meet the correct way of doing refundable, and there had to be certain characteristics, and they had misinterpreted it apparently. So I suspect we'll see those coming back up, but right now they might be missing. So if you see something missing that you think ought to be there, that's probably why. Just really quickly, borrower paid monthly, if it's deferred, that's excluded from points and fees. And lender paid single premium, because it's rolled into the rate, is excluded from points and fees. Borrower paid single premium, non-refundable, however, would be included entirely in points and fees. So be very careful, because you could go over your 3% right there. And your split premium, which is a product Radian has, I think Magic has one similar to it, where you pay monthly and upfront. If it's non-refundable, the upfront portion is obviously included in the points and fees, and the monthly is excluded because it's simply paid on a monthly basis, and there's no refundability after that. So that's just a really short version of MI, but I just want you to be really, really aware of it and make sure you check to see what's of most benefit and how it fits in. So let's talk just a little bit about QM testing. Calyx and DocMagic both provide testing, and they both work pretty well, finally. It took a couple days, but they got the bugs straightened out, I think. And they give you the results so that you know both the QM type and the status. Biggest recommendation here is test early and often. Run it anytime a loan changes. Doesn't hurt to rerun it, and it can flag you to some issues. So let me show you a couple examples. Notice that below this update status here, there's a bar that says QM finding, and there's nothing in it. That's because it hasn't been run yet on this one. You click the QM button at the bottom of the screen. It's a little tab down here next to subfinancing and mortgage insurance. All you have to do is click that to run it, and it automatically populates the status. So from then on, you will see it up there in Calyx. This one, I think, says General QM Safe Harbor, if I remember right. And then you click the QM button at the bottom to pull the report anytime you want to look at it again. And this is what it looks like. It's actually a 4-page report. There's more stuff down here, but I just clicked in a little part of it to show you General QM Safe Harbor, and then it gives you all the tests down here. I'll show you an actual one in just a moment, but this is just to give you an idea of what it looks like. So Loan Scorecard is the KLX report. DocMagic includes this report as part of their standard report that runs with all of the DocMagic document orders. You know, that 5 or 6 page thing that maybe some of you don't look at and you probably should. It does, DocMagic, first of all, before you even run anything, before it prints that report, it comes up with warnings. And those are there for you to pay attention to if you need to address them. So when the processor is getting ready to run docs, it will come up and tell you if there's anything missing. Again, the QM report will run automatically. You don't need to do anything to request it every time you order documents. It will run. If a loan application was taken before January 10th, you can ignore the part that is specific to QM because I think they're printing everything at this point. But please pay attention to all the other stuff. This is where all your high cost tests are. So if you're not reading them, you're doing yourself a real disservice. You could have an ineligible loan and it's right there in front of you, and if you don't read the report, you wouldn't know it. So that report is there for a good reason. That's paid for as part of the documents, and please take advantage of it. The only exception, by the way, that it's January 10th is if it's an FHA loan where you've ordered the case number later, and make sure that you're actually looking at that part of it. Here's a sample finding that shows up from DocMagic. It does give you warning issues, and you will notice that this warning issue here says, the third one down, this is a federal higher-priced mortgage loan. There's your HPML. The APR exceeds the comparable average prime offer rate by 1.5% or more. Now, if this was an FHA loan, it would have a slightly different message because it's calculated differently under FHA. So it tells you that the liability protection determination is rebuttable presumption. Remember I said that whether it's safe harbor or rebuttable presumption indicates how much liability a lender has, whether they're more or less open to liability. So that's what they mean by that. They repeat that down here. And they're literally telling you that the APR of 6.555 does exceed the average prime offer rate, the APOR threshold of 6.1. So that would be basically the APOR plus your 1.5% comes to 6.1, and this is coming up to 6.555, and that's why it's exceeding it. Here's another sample. This actually shows up in the report. It tells you that you passed the total points and fees because they don't exceed 3%. The loan meets HUD qualified mortgage guidelines, so it's an FHA, this one. The other one was conventional. It meets HUD qualified mortgage liability protection. It is determined to be a safe harbor because it's under FHA. And here's the calculation for FHA. APR of 6.555 does not exceed the average prime offer rate of 4.6 plus the annual MI percentage rate of 1.35 plus 1.15 percentage points. This little note at the bottom is a glitch on their part. I think they fixed it by now, but I pulled this in a few days ago before they'd done that because they had not finished updating for FHA loans yet, so never mind that one. But it did pass the important stuff. We'll be doing additional training, and we're going to be revising things as we receive new and updated information. There are a couple other training issues. If you've got any questions, you can type them in the checkbox. I do have a couple more things. Don't leave me yet. Got a couple more things to show you so that you're aware of it. Let me close this. Whoops, I didn't make any changes. So I'm going to tell it not to save it. And I just realized I did not open Point earlier. Shame on me. Give me just a second to sign into it. And while it's opening, I'm going to show you two other things. Because we all know it takes a while to open. All right, while it's doing that, let me go in here. One of the other things that came out recently, and there was a README that came out Friday on this, and it basically, let me make sure I didn't have any messages from anybody. Okay. basically came out and said you must offer a housing counselor worksheet to all of your borrowers. This is what it looks like. I ran one using my zip code. It gives you this nice little blurb about it, shows you approved agencies. CFPB came out with this and said they thought it would make sense to give everybody a listing of the housing counselors. You have to give at least 10. So there's supposed to be 10 down here. This is a 3 or 4 page list. You can see that my home doesn't have a lot of housing counselors nearby. Most of mine are in West Palm, which is some miles away. But that's okay. It doesn't say how far away they can be. It just says you put in zip code. Normally it's wherever the borrowers live. You put that in, and this is how you can then pull this list. It's right off the CFPB website, and this is acceptable. There's also a new document that should be printing out with your doc sets, and it is an acknowledgement, and it tells you, it has the same information on it here, but it doesn't pull the specifics. And the reason the CFPB did give us a little bit of leeway as to whether we had to give the list along with that document, but we've made a corporate decision because some of our investors want to see it that you need to pull the list as well. The list needs to be given to borrowers within 3 business days of application. And that, like I said, that readme did come out Friday morning, so make sure you've seen it and that you're doing that for any application stated on or after the 10th. 2 cautions, it goes to everybody, even investors, and don't even ask me to get into how silly I think that is, but that's life. And secondly, it does not mean they have to have counseling or that they have to take it. It's purely voluntary unless it's required by a loan program, and I don't think any of ours currently require it. But you have to give them a list anyway, so fun and games. Okay, I have a comment here, so let me take a look real quick before I go on. Okay, did you copy? Yes, Todd, you copied this to everybody. So this is Todd's question about using the 3-year continuance for income. That has not changed because that's agency guidelines. And CFPB did not overwrite agency guidelines. They simply put some base guidelines in place. So if FHA requires a 2-year continuance of something or a 3-year continuance of something, you must still meet that. This doesn't mean that you can get out of doing that. Okay, hope that answered it. Alrighty, let me go very quickly into Calyx, which has fortunately opened, and I want to show you 2 loans. These are sample loans, obviously. I don't want to mess with a live loan. First one is David's sample, and I just want to show you this quickly. You can see I have samples from all of the respective branches. This one's actually been run before, and up here in the corner it shows agency QM, so that's how it looks when it prints. Here's your button down here. I hope everybody can see this okay. And when you click on it, you get, I don't know why it moved it over to my second screen, but when we pull it over here so you can see it, the report pops up. So this is telling you this is an agency QM, it's Safe Harbor. And this is the report out of Calyx. I'm not going to attempt to show you one out of DocMagic because I have to draw documents, and that would take longer. But if you go down here to QM assessment, it literally says max points and fees of 3%. It's only at 0.97, so it passes. Maximum loan amount, that passes. Loan term, 30 years. There we go. No, it's not balloon. It's not negative. It's not interest only. The APOR that it picks up, by the way, this loan is not indicated as being locked. So it picks up the APOR that is in effect as of the date that this was run, which is usually a day or so before. It could be the day of. And what it does then is it takes the APOR plus 1.5 and it tells you this is your threshold. And the APR in this loan is much lower than that, and so it's a safe harbor. The rest of the report, if you've not seen it, does give you a quick capsule of your points and fees. And then it tells you what's included. It literally goes down here and says, who's paying it, and it's showing you what you have in your system. So this is a really good audit tool for you to take a look and see, okay, how is my system set up? Is it right? Is it wrong? If you see something wrong, by all means correct it and then go back and rerun it. It gives you a quick summary of the loan as well. It gives you a quick summary of the income. It tells you, your loan details, picks up liabilities, picks up income, assets, and then it gives you some QM messages that are just reminding you of things like you're required to retain evidence that you complied with this, which we do because we keep images for 3 years. Interestingly enough, there's some states obviously require more than 3 years, so we keep it longer if we have to, but we always keep everything at least 3 years. So that's a report from this one. Let me close that one. Before I go on, just in case you have a problem, if it comes up with a blank sheet like this, and then in the middle of it you get this nifty little box that says unable to contact, unable to connect to the internet, or unable to contact the internet, just say okay, and then go back and click your QM button again, and it'll come right up. It caused me, little heart palpitations for a minute there. Let me see if it'll do it on this one if I click it to do QM. I think it'll give me the message, the error message. And apparently, because it's rerunning it. Yeah, there we go. That's the one I'm talking about. Unable to open the internet site. So if you see this, don't panic. I think it's a Windows 7 message, and I don't know how many of you are on that, but I've been showing this to everybody so that they just don't panic if they happen to see it. Just if you cancel it, and then you go back here and you click on QM, it opens your report right away, and it's rerun. That's how you rerun it, is right like that. Okay? Let me close this one, and I'm going to show you one more. And this one is John Simple. I'm getting tired of these two guys. I should pick somebody else, but they work. This one has also been run. And then we'll click QM again. And if I want to rerun, I click here. And I'm going to get that error message this time, I'll bet, again. And it gives you the most interesting looking messages. Maybe it won't because I just ran one. We'll see. Yeah, it's going to. Okay. So you just click OK. You close this. You go back here, click that, and it opens the report. I figured I'd show everybody that so you don't panic if you happen to see it. So this one also, same calculations. It's under this. It's showing all your calculations. Your APOR in this case. This was a long ago lock, and I wanted to show you the difference that in this case, instead of picking up current APOR, it's picking up the APOR that was in effect on the lock date. It was locked on 12/1. APOR was dated 11/25, so it's a little bit different. The threshold is different. Okay. So that's how that looks. And the last thing I wanted to tell you about, and I'm not going to do it in this presentation, but I do have a presentation on homeownership counseling form. We're going to be doing that. We did send out an email on that, and we just put together the presentation on residual income. That one will be available tomorrow, just to confirm what it is for you. And so watch for the invites to come across for that. I'm going to unmute and open this up, and anybody have any questions, I'll open it up for you. Any questions, anybody? Going once? Okay. If you don't have any questions, then we're finished, and I thank you very much for attending. I hope it helped.
Thank you, Jeannie.
Thanks.
Thank you, Jeannie.
Have a lovely day. Bye-bye.